Good afternoon, everyone. Happy New Year and welcome back to a brand new 2024. Hope all of you had very good breaks and had made some great memories during your holidays. And now we are back to battle the markets. My name is Thilan Wickramasinghe. I'm the head of research for Maybank Singapore, and welcome to Market Mondays. A very a stronger, I would say, U.S. jobs report, as well as some of the stricter tech regulation in China, are keeping the markets on edge, especially when it comes to the direction of where ASEAN markets are going. Um, how is how is this going to affect Singapore, and how is Singapore placed going into 2024? That's something that we're going to discuss from a macro perspective. We've got our economist Brian on the line. He's going to take us through that with some forecasts as well as some highlights. Then I'm going to take over and I'm going to talk about our Singapore market strategy as well as our top 10 stock picks for 2024. And then we're going to drill down to one of the key sectors that we think is important this year, the Singapore REITs. And we have Krishna online who will take us through that. But first, as usual, let's look at the market moves. We saw that the S&P is up about 0.2% last week, as well as the Dow Jones, which is up about 0.1% as well, largely driven by some of the US jobs data that is coming through. We also saw the Japanese markets also up about 0.3%. Across ASEAN, though, generally quite mixed. The Jakarta and the CT down about 0.1 to 0.5%. The SDI was up about 0.3%, partly driven by the banks. We did see on the commodities side, oil actually rising about 1.5% for Brent crude, partly driven by the issues that are happening in the Red Sea area. We saw Bitcoin giving up some of the gains from last year, down about 1.2%. Now, with that, let's start with macro. And here I've got Brian, who's a macroeconomist looking at Singapore on the line. Brian, welcome to the show. Now, Singapore's fourth quarter GDP actually ended up in a pretty decent high note, accelerating to about 2.8%. So, what's your take on the latest GDP readings? What are some of the standouts, and how does this gel in with what you were thinking for 2023?
Yeah, hi Dylan. Thank you for having me. Hi everyone. Yeah, so indeed, the GDP growth in the fourth quarter surprised us at 2.8%, and that exceeded our expectations of 2.5%. Basically, if you look at the growth breakdown, the main reason was a strong manufacturing and construction recovery, while services growth was largely steady. I think maybe special mention to construction, which surprisingly accelerated to 9% compared to just about 6.2% in the third quarter. I think to put things into perspective, the construction growth was the strongest in a year. Activity has been upbeat given the backlog of public and private sector projects and also reopening normalization tailwinds. After all, the sector remains about 19% below pre-pandemic levels. I'll give you an example. HDB said that it completed 21,400 public housing flats in 2023, and this is the highest number in the last 6 years. So that definitely contributed to construction activity. I think moving on to manufacturing growth rebounded to 3.2%, and that snapped 4 quarters of consecutive contraction. And this was due to green shoots in exports. We're seeing a gradual export recovery. We think that electronics and transport engineering will likely the leading growth manufacturing clusters, given the recovery in international air traffic, shipping, and global electronics demand. I think if we look at 2024, the outlook, we are expecting stronger and more balanced economic growth of 2.2%. That's compared to the 1.2% seen in 2023. We are expecting a brighter manufacturing outlook. Global electronics demand is recovering, driven by a replacement cycle with new models and upgrades for tech, depleting US inventories, generous US subsidies on semiconductors and electric vehicles, which will support import demand, and also an artificial intelligence AI boom. Construction, we're expecting it to continue expanding at a robust pace as it normalizes further towards pre-pandemic levels. And this is given the backlog of public and private sector projects that are still in play, such as in public housing, infrastructure, healthcare, and hospitality. And also new projects will support construction activity, such as the $4.5 billion expansion at Marina Bay Sands. In the services sector, revenge spending in consumer services will likely fade as the pent-up demand cools off, and high prices and a strong Singapore dollar could also be crimping demand for hospitality, retail sales, and food and beverage services. But trade-related and outward-oriented services sectors, including wholesale trade and financial services, will return to positive growth in 2024 with the global demand pickup and also easing domestic interest rates. Loan demand could see a turnaround in the quarters ahead as trade volumes and business loans pick up with higher trade financing, while consumer loans start to recover as mortgage rates slide. We are expecting our 3-month SORA rate easing in the second half from the current level of 3.7% to 3.25% by end 2024, tracking the Fed rate cuts. Now, if I move on to just some downside risks that we are thinking about for the economy in 2024, I think this includes higher for longer US and global interest rates amid still some uncertainty about the Fed's future rate path. And this may hurt global growth and threaten the export recovery, which Singapore is so sensitive to. The Red Sea's ship disruptions are also a risk worth watching, as any major and prolonged escalation may disrupt supply chains, inflate shipping costs, and dampen global trade. Another risk is a renewed climb in domestic inflation. This could stem from more persistent labor market tightness or fresh commodity price shocks from a broadening of the Middle East war, Israel-Hamas war, is El Nino or other weather events. Ultimately, higher for longer inflation, we fear that it may crimp purchasing power and household consumption, and it may also induce the MES to be forced to tighten via steeper appreciation bias to contain price pressures. And this would ultimately hurt the economy and also hurt our export competitiveness. So yeah, that's my the outlook for 2024. And back to you, Dylan.
Thanks, Brian. So acceleration of GDP growth, a fairly broad-based sort of growth across manufacturing, construction, as well as some of the services sectors as well. But it's not without risks, particularly in terms of some of the higher interest rates, remaining high for longer, as well as some of the geopolitical risks as well. Thanks, Brian. That's a very comprehensive outlook and obviously quite positive for Singapore as we go into 2024. Now, let me kind of take a step back and put that into context for the markets. We've just published our Singapore strategy note for 2024, and that has our top 10 picks as well as where we think the market will go this year. But let's look at 2023. The STI was ended up flat in the year. That is still a better performance than what we saw with the KLCI or Thailand Set Index, but certainly a worse performance than some of the North Asian markets like Japan, Korea, as well as the US as well. Now, from a fair value from a valuation perspective, from a PE perspective, the STI is now trading at a 50% discount to the S&P. This is the cheapest the index has been in its history. So I think, when we are at this sort of inflection points, there are opportunities. But we need to also still take into consideration the fact that the Chinese economy is still sputtering. The US fiscal impulse, the domestic spending in the US is very, very strong, which is continuing to support some of the US market. So until some of these issues start to get rationalized, ASEAN valuations will probably be a bit capped, and I think Singapore will be included in that. So I think at least going into the first half of this year, investors will need to be a lot more selective in terms of the stocks that they pick. So and we title our report "Time to Cherry Pick." So time to pick the best stocks to ride this out. Now, looking at 2024, we think that market earnings will grow at about 3% year on year. Now, that's a much slower pace than the 18% that we're expecting 2023's earnings to close, and we'll have a better idea around February this year when fourth quarter results come out. But last year there was a lot of support from the fact that the banking sector saw margins increasing because of high interest rates, and also Singapore reopened early, so there was some tailwinds from some of the reopening impact as well. But at the same time, this 3% sort of growth does have potential for upgrades going into the year. Areas like interest rate cuts, semiconductor inventory building, bigger order books for the offshore and marine sector, as well as green energy, should see support coming in for a lot of companies that might drive some of these earnings upgrades as we go through the year. Plus, we also see four very unique um, themes that are taking place in Singapore, and they're all happening pretty much at the same time. The first is we're seeing a lot more corporates as well as GLCs restructuring, and we think that will accelerate going into this year. And largely this is being done so that they can drive better return on their invested capital. Shareholders have been calling for better return on invested capital, and we're starting to see companies respond to that. And the results are there. The shareholders are really rewarding companies who do this. If you look at some of the earlier GLCs that have restructured, particularly back in 2020 to 2023, we see that the restructured GLCs have actually outperformed the STI by around 15%. Second theme that we're seeing is increasingly institutional investors have to allocate more and more of their AUM towards sustainable investments. Now, when you look across Southeast Asia, Singapore has some of the lowest risk sustainable companies across the region. So naturally, Singapore should receive a larger proportion of sustainable investments, sustainable allocations from institutional investors. And, we did see sustainable investing slowing down in the first half, but our ESG research team expects that pace to have picked up in the second half of this year, second half of 2023, and we should start to see some of those results coming through around February this year. Thirdly, we expect more regional M&A to happen by Singaporean companies. A lot of Singaporean companies are looking to supplement slower growth at home with faster growth in the region. And a strong Sing dollar, cheap valuations across the region, as well as a lot of the themes on supply chain relocation from North Asia to ASEAN is taking place, and a lot of Singaporean companies are well placed to benefit from some of these key changes. And then finally, Brian also mentioned this. We think technologies like AI, 5G, IoT, they will drive the next wave of cost savings, as well as drive the next wave of new revenues as well. And here again, a lot of Singaporean large caps have been investing quite early in technologies like 5G and IoT and AI. Particularly the banks, for instance. So they probably will benefit ahead of a lot of other regional peers. And at the same time, Singapore has a national AI policy as well. So that should again provide the regulatory tailwinds as well in driving a lot of these changes. So I think there is a lot of opportunities here to drive earnings upsides. STI target for this year is 3290, which is about 3% higher than here. And largely that is because of valuation discounts that I talked about, because until we start to see, can you continue to keep on the sector slide, please? And that's largely driven by the valuation discounts that I talked about from China's slower China, as well as some of the US market strength as well. Now, from a sector point of view, again, that means that you need to be a little bit more selective. And now this slide here shows you how we are kind of placed in terms of our sector preferences. We are more positive on sectors like gaming, industrials, a little bit on internet, as well as some of the REITs, services and transport sector, as well as the telecom sector and some of the technology sector. We are a little bit more neutral on some of the large cap sectors like the banks, as well as plantations and some of the developers as well. Now, when you go drill down to our stock positioning, next slide, I think the way we are kind of positioning ourselves at the start of this year is to cherry pick the best stocks that are geared towards these themes, as well as the stocks that have been laggards last year, but now actually can turn into leaders because they will benefit from interest rate being cut or inventories being built. So you can see on the theme side, we have stocks like Comfort Delgro, DBS, Dynamac, and Singtel, who will benefit from ESG, restructuring, M&A, AI. And on the laggard side, we're a little bit more heavy on REITs like Ascendas REIT, CICT, as well as Lendlease Global Trust. And at the same time, a few more tech names as well, like Franken and Venture and Genting Singapore as well. A lot of this is available in our newsletter today, so we have a very comprehensive report. So I do encourage you to read the report to get into depth for as you look at building your portfolios this year. Now, to go to our chart guy, Nick, his views on the STI kind of dovetails with what we are saying. STI has generally been range bound around the 480 points sort of range, and he thinks that it'll continue to be range bound in the near term. But contrastingly, on the S REITs, he is a lot more bullish, and he thinks that the downtrend that was seen last week has actually sparked a new favorable bias on the S REITs index. So he expects the index to set an uptrend going into the near term. So I think this is a good opportunity to bring Krishna in, and our S REITs analyst at this stage. Krishna, welcome to the show.
Thank you, Thilan. Thank you very much for having me.
Hi. So Krishna, you published a report where you talk about your 2024 roadmap for the REITs, and you're calling for higher peaks and deeper valleys. So why are you expecting so much volatility?
Yeah, precisely for the reasons that Brian alluded to, and also you alluded to in your Singapore strategy note about the growth being a bit more uncertain. A lot of geopolitical factors are there, and inflation, the trajectory of inflation is a bit uncertain. We are seeing for the Singapore context that inflation has been higher than the real growth for 6 consecutive quarters, which is a record since 2000. And this kind of sets the tone as to how difficult it is to get the inflation number down with the various shifts ongoing in terms of the supply chain and the geopolitical concerns. So one data point which suggests that we are having a soft landing, slowing growth can lead the sector to show massive growth, what we have seen in December, rather starting from the November itself. And then one data point which suggests that things are not as rosy can lead to some introspection and sell-off. So I think that is why I think I have titled my report as higher peaks and deeper valleys.
Okay. Yeah, okay. So bit of uncertainty. I think we need to see a little bit more data points coming through now. But when you drill down to like the subsectors, how are you kind of settling in on the different subsector views?
So I think in the report we mentioned that we have become subsector agnostic. I think going into 2023, we started with industrial and hospitality. Industrial did well, this has been supported by the strong growth in the spot trends for sectors such as logistics. It has also been supported by flatted factories as well. Hospitality, yes, the counters did deliver on distribution growth because of the low base effect, but that did not turn out positive for the share prices itself, barring a couple of idiosyncratic names such as Fraser's Hospitality Trust and Far East. So I think coming into 2024, we think that the choices for subsectors are a lot more difficult because for industrial is well owned and supply is coming into fruition. So I think the growth for the spot trends will be not as easy as it was in 2023. For hospitality, it is very much contingent upon whether we are able to get the Chinese demand to come in. I think the Chinese visitors are undershooting the pre-pandemic levels. And the hoteliers are already talking about lowering the room rates and focusing more on the occupancy. So it is very much contingent upon how the Chinese demand comes through and without any reopening tailwinds. Coming to office, I mean, I think we all know that the office occupancy overseas is definitely weak. In Singapore, it has come back to about 75 to 80%, but still, I think overall economic activity is continues to be muted, and we are already saying that services will be slower now, and manufacturing will pick up the slack. So that does not set up. It's not a good constructive setup for office demand itself. Further, we the main driver of the demand in the first half of 2023 was the small space take up by a lot of the family offices, and now what we understand is the approvals are a bit slower, so that also will impact the office demand. But suffice to say, if economic growth picks up, then definitely this is a sector to watch, because the supply is very limited. And though there is some shadow space, if economic growth picks up, then definitely the marketing of those spaces will also be at a higher rent levels. And finally, on the retail side of thing, definitely the Singapore retail consumer consumption is relatively resilient. The recent data points have been a bit soft. But if unemployment does not pick up massively, and we do have a control on the inflation, then we can see some positive data points around the retail sales itself. And for the city center, it will again very much be dependent upon how the tourism picks up. So it's a resilient sector, but we need to watch out for the consumer sentiment itself, which again will depend upon the growth and inflation numbers. So I think the sector's choices and the sector drivers are not that clear cut coming into 2024, and hence we are more stock specific rather than sector specific. And I think that dovetails to your strategy note piece as well, where you're saying more to cherry pick rather than having any broad-based view.
Yeah, so I think this year a lot more homework needs to be done when we're looking at stock picking. So Krishna, let's go into your stock picks. So what are your sort of key stock picks at this stage?
So I think the top names are CICT, Capital and Ascendus, and Lendlease Global Commercial REIT. So I think the main reason is the few things which we have taken into account. The first is obviously the liquidity that the stocks offer, so that if you have got your thesis wrong, you are able to get out without much impact. So the CICT and CLAR kind of ticks mark both those boxes. The second thing also, we have looked at overall, how they are positioned against any wrong judgment on the interest rate or the FX side of things. So both of them are A-rated credit, and they do have buffers to manage any repricing of the borrowing. And on the FX side, CICT is of 90% Singapore dollar income. And for Capital and Ascendus, they do natural hedging almost for all their overseas exposure. So there is, the cushion for impact on any kind of wrong view on the liability side of things. For Lendlease Global Commercial REIT, it's a small cap name. Obviously, it does not provide you that much of liquidity, but the comfort factor here is that they also have predominantly Singapore income. About 80% of the distribution comes from Singapore. They do have well-located assets. The overseas assets that they have already taken a valuation hit, and they are still trading well below book. So if there is any sustained rate cuts, then the names such as Lendlease Global should benefit, because there is a lot of concern around their gearing, and as well as the upcoming maturity schedules that they have in 2025. Suffice to say, their acquisition pipeline is quite robust, coming from their sponsors, various projects that they are having in Singapore and globally. So it is more of a view that investors have to take. It is not an easily tradable stock. and one has to take a mid to long term view on that name. So those
Great.
are my topics for the sector.
Thanks, Krishna. I just realized our CICT stock price was in ringgit, so that's
Yes.
wrong.
Oh.
So please
Mhm.
do, please, we apologize for that. Okay, now let's quickly go into upcoming events. We've got quite a few macro dates coming out. We've got Singapore's FX reserves coming out on the today. We've got the Nodex numbers coming out on the 17th of January and the inflation numbers coming out on 23rd January. Everyone's looking for the property price index, given the sort of roller coaster we've had last year. URA property price index comes out on the 26th of January. We have a few key events that we are hosting as well. We've got the country strategy outlooks for across the different ASEAN countries. Again, on the 12th of January, please do speak to your salesperson if you want an invite for that. We have a Thai Tech Day as well, which is on the 16th of January. And I do want to highlight on the 20th of January, we have a market outlook and a feng shui outlook seminar at Singapore Exchange happening. It's going to be a fantastic event. A lot of fun activities as well as up close and personal with some of our analysts, as well as with a feng shui master as well. So if you haven't signed up for that, please do scan this QR code and sign up because seats are limited and they're on a first come, first serve basis. With that, we are out of time for this week. Thank you so much for joining us on Market Mondays. We hope to see you next Monday. Please do ask your friends, colleagues, everyone else that you like to join our webcast. That really does help us to build momentum. Have a profitable trading week. Thank you.
Recording stopped.